A major development may be underway in the global silver market. On Friday, November 28th, during one of the lowest volume trading periods of the entire year, Thanksgiving weekend, the CME halted gold and silver futures trading, citing a cooling issue at a data center. But the timing, the market structure, and the underlying physical shortages raised serious questions about whether this was simply a technical glitch or something far more consequential. Today, we break down what actually happened, why the physical silver market may be reaching a breaking point, and why this moment could mark the beginning of one of the most significant structural shifts in precious metals in decades. This is Smart Wealth Code, your compounding machine. Section 1. What triggered the halt? In the hours before CME halted gold and silver futures, something extremely unusual occurred. Silver broke above $54 per ounce in both spot and futures markets. For a period of time, futures prices surged nearly $1 above the spot price. This created a massive contango, a situation where futures trade significantly above spot. Under normal conditions, this should not happen in silver, especially when physical inventories are tight. Why is this important? Because recent months have shown London's LBMA vault silver inventories have been falling sharply. The LBMA has been pulling metal from Comex to meet physical demand. In order for that transfer to make economic sense, LBMA spot must be higher than Comex futures, a state called backwardation. But when futures suddenly move far above spot, it becomes uneconomical to ship metal from Comex to LBMA. The physical supply chain breaks down, delivery pipelines seize up. This is exactly what happened right before the CME halt. Section 2. The official explanation doesn't add up. CME attributed the shutdown to a cooling issue at a data center in Illinois. But consider the context. These are among the lowest volume trading hours of the entire year. Professional IT specialists have pointed out that high-end financial data centers run redundant cooling systems. N+2 redundancy, meaning multiple backups exist even if several components fail simultaneously. No other clients tied to the same data center reported outages. A multi-hour failure of such a robust system during one of the quietest trading windows of the year is statistically unlikely. Combined with the market behavior right before the halt, the explanation raises red flags. Section 3, physical silver liquidity is drying up. Beyond the trading halt, there's a deeper issue. Global physical silver liquidity is evaporating. Key signals include LBMA free float, decline. Multiple sources have indicated that London's available, unencumbered silver supply has fallen to critically low levels. Comex vault, outflows. Comex inventories have been declining for months as physical metal flows to London and Asia. Silver inventories in Shanghai's major vault systems have fallen to levels not seen in years. Estimates suggest China may now have under 700 metric tons of freely available silver, a dramatic shift for the world's largest physical market. Market data and industry reporting confirm that China shipped silver to London in October to help stabilize supply. A significant portion of that metal reportedly went directly to India, not even to LBMA vaults. This suggests LBMA's physical buffer is thinner than most people realize. Sovereign demand is rising. Emerging reports indicate that sovereign players, especially in the Middle East and Asia, are buying Comex futures specifically for delivery, not speculation. These buyers do not accept paper substitutes. This is where the situation becomes critical. Comex rules allow cash settlement. If too many large buyers stand for delivery and metal is not available, the exchange can settle in cash instead of metal. If sovereign buyers push for real metal, the system faces a stress test it may not withstand. Section 4. Why the contango event was dangerous. When Comex futures spike above LBMA spot, three things happen. The pipeline of metal flowing to London freezes. Arbitrage breaks down because nobody ships cheaper metal to a cheaper market. Physical shortages worsen. potentially triggering delivery stress. This is why a sudden halt during a contango breakout is suspicious. Letting the market run may have accelerated. Physical depletion, short squeezes, delivery failures, a major breakout in silver prices. Halting the system pauses the pressure and gives time to coordinate a counter move, often a short selling attack when markets reopen. Such patterns have been seen repeatedly across decades in precious metals. Section 5. The global shift toward physical metal. Perhaps the most important trend of all, China, India, and the Gulf countries increasingly demand physical silver, not paper contracts. Dubai is positioning itself as a future hub for global silver trading. New tokenized physical silver products are emerging, backed entirely by real bars. Western ETFs, many of which are unallocated, face growing scrutiny as clients request real delivery but are discouraged or denied access. This indicates a major transition. The world is moving away from synthetic silver exposure and toward real, tangible metal. When this happens during a period of shrinking supply, the price mechanism can break violently to the upside. Closing statement. Whether the CME halt was a genuine technical failure or a deliberate intervention, the surrounding circumstances point to one clear truth. Global physical silver is running out, and the paper market structure that has kept prices artificially contained is beginning to crack. This is a moment that comes around once in a generation. Those paying attention will recognize the significance. We will help you stay alert. This is Smart Wealth Code, your compounding machine